A lot of people will hear about options and get scared, and they should be. Options are very, very volatile. They can fluctuate in price by 100% or more per day. But if used properly, it is a great way to generate income on stocks you own currently. It is called selling covered calls on the stocks that are currently within your portfolio. Sound too good to be true? Always caveats to things. But here in our community, we recommend dollar cost averaging into low cost ETFs. And for a portion of your money, if you think you have the ability to buy value oriented stocks, you can take that portfolio of stocks and sell covered calls on it in order to generate extra income and extra return. This is especially useful to learn now because when you decide to retire someday, you might be able to keep your entire portfolio and just live off your dividends and your option income as time goes on. So in this video, I'm going to explain how you use the covered call process to generate income on your portfolio. So what is a covered call? A covered call is this. Let's say you own one share of SPY. SPY is the S&P 500 ETF sold through Spider. It's currently selling for around $400. Now, one thing to keep in mind, in order to sell covered calls, you should have 100 shares of the stock. So right now, you need to have about $40,000 worth of SPY. Now you might be watching this saying, I don't have that. It's fine. As long as you have 100 shares of something, you can do this. So I'm just using SPY as my example. Okay, so let's say you have SPY for $400. How do you generate income off this? Well, here's what you're doing. You're going to sell someone the right to call the stock away from you at a certain price and a certain date in the future. So let me give a made up example. Let's say today is August 29th. Let's say you want to sell somebody the right to take away SPY on September 30th at a price that's higher in the future. Let's call it $420. So you're going to sit there and assume that SPY goes up 5% between now and September 30th at most. And let's say they pay you $2 for that right, okay? They're gonna give you $2 times 100 shares. They're gonna give you $200, okay? Between now and September 30th, if the stock stays right here and ends below 420, you keep the full $200 plus you keep all your shares, your entire 100 shares of SPY. Okay, and you just made $200 easily. So what is the risk of selling a covered call? Let's say the stock goes to 430. Well, here's what you got. You got all the gain from 400 to 420. Somebody paid you $2 per share, but you lose everything between 420 and 430. When I say you lose, you don't get the extra $10, but you get the full $20 a share plus the 200. You always keep the $200 in premium that you received. When it goes above 420, you are sacrificing that entire gain. So really, a covered call, the thing you're risking is the gain above a certain level. So when do I recommend selling a covered call? It's especially useful if you think that a stock you own is at its full value or very close to it. So as an example, I'm going to make up a company. Let's say you have company XYZ and you bought it at 20 and you thought it was worth $50. Okay. Well, fast forward a year, it's now at $45 and you still did an analysis and it's worth $50 still. Okay. You still think it's worth 50, but now it's much closer. What you can do now is you can sell a covered call at that $50 strike price and you'll get paid to get the stock taken away from you at the price you want to sell it. That is the best way to sell covered calls. Now, in the way I did before with SPY, your goal should not be to get rid of SPY. Your goal should be to sell really far covered calls to generate some lower income along the way. Doesn't come without risk, but the point is you can pick up these pennies along the way. Is it a guarantee? Absolutely not. Look in July of 2022, just last month, the S&P went up 9% in 1 month. So at the end of June, if you'd sold a covered call for a 5% increase by the end of July, you would have missed out on 4% of the gain. That's a pretty big number. Now, July is obviously a fluke month, but that's a pretty big number. But the goal is, what I recommend doing is, maybe instead of selling it one piece, you sell different levels. So going back to SPY, if it's currently sitting at 400, what I like to do is, I'll sell a portion at 420, a portion at 440, and I'll keep a portion completely uncovered. That way I get the full gain along the way. And my goal is to generate income. So let's actually sit here and look at how you figure this out when looking at an options chain on your account. Now, for most brokerages, you need to have approval to do options. The good news is on selling covered calls, they look at it as very low risk because you're not, if the stock goes, oh, that's the other thing. Let's say the stock, the SPY is at 400, somebody pays you $2 a share, and let's say the stock goes down to 380. Guess what? You still keep the $2 a share and you don't lose the shares. So you're just collecting income along the way. This could be a great way to generate income as stocks go down. If you believe that stocks are going down over long periods of time because they're overvalued like today, this is a good way to generate income to offset some of those losses. So instead of losing $20, you actually lost $20 in value, but you got $2 back in premium. So theoretically, you only lost $18. That's a pretty nice way to cushion your blow. Now, I've heard situations, there's a book I love called The Warren Buffett's Next Door. And I forget what chapter it is, but it's the second or fourth chapter, I think. Talks about a guy named Ray. His goal is to generate 8% per year extra on his portfolio just from selling covered calls. There are times when he sells 15%, it makes 15%. There's times he probably breaks even or loses a little bit of money. But overall, his goal is to add an extra 8% per year. Now, remember, if you're part of our software, let me show you how useful extra percentage points are per year. So let's go to our retirement calculator because I want you to understand exactly how useful this can be. Let's say you're 30 years old and you're going to retire at 65 and your current savings is $100,000. And you're going to add an extra $15,000 per year. And you're going to increase your annual savings by 4% a year. So this year you're doing $15,000. Next year you're going to do 4% above that, which is $600. So $15,600 and so on. Now let's say you just put SPY as your portfolio. And over long periods of time, you're able to get 9.5% return. And during retirement, you pare things back and you do 6% return. And you're going to live to 100 years old with 3.5% inflation. And let's say hypothetically right now, you currently make $100,000 a year. And you want that full 100% of your income in retirement. So as time goes on, your income's going to go up 3.5% a year with inflation. And at the end of when you get to retirement, you want to live on 100% of your last years of income. Do you have enough to retire? Generate? You do. At the age of 65, you will have $8.7 million. Wonderful. Now here's the benefit of covered calls. Let's say along the way, you're able to generate 2.5% extra in covered call income. So it takes your 9.5% to 12%. Now, this does not account for taxes. So keep that in mind here. I'm not accounting for taxes. Let's see how much it changes the game here. Instead of 8.7 million at the age of 65, you now have $16.2 million. It almost doubles your net worth there just from selling covered calls and reinvesting it. Now, here's the beauty. If you do this in an IRA or some other tax-deferred account, this is an accurate number because it'll grow tax-free along the way. That's the huge key here for the average person to make money. And you might sit there and say, Paul, I don't have 100 shares or anything. Fine. But there are ways to sell what's called the poor man's covered call. I will be explaining that in another video in the future when you have less than 100 shares. But for right now, if you do it this way, I want you to also learn this now, because when you turn 65 or when you get to 50 or 45 or whatever level you need to be to have 100 shares of something, this will amazingly allow you to sit there and generate extra income for retirement. Not only that, during retirement then, you might be able to increase your returns to 8%. And look at the money you'll have when you pass away, $150 million, just by doing this. When before, it was passing away with 6.5 million. Look at the difference. Would you rather retire with 150 million or 6.5 million? You tell me. That's the key. So now let's go to our options chain to look at exactly how this is done. So this is Webull. I'm not endorsing it by any means, but they have a really good options chain. I don't use it for any trading. Please do not take this as an endorsement. But if you're new to this channel, I'm Paul. I'm a value investor. My goal is to find companies that are selling for less than what I perceive to be worth based on the quantitative and then qualitative aspects. But I first start with the numbers. That's my first screening process. And I use my 8-pillar portfolio to figure out the companies that I want to look at and what questions to ask next. Again, my goal is to learn more about the company through the quantitative aspect, the numbers, and then go look more research to see how the company is operating. The more you learn, the less you will fear. The more you learn about options, the less you will fear. That's a big key here. And if you want more on my personal life, follow me on Instagram right here, and you'll see a lot of pictures of cute puppies and my fiance and I having fun. So anyways, so let's figure this out. Let's say we have SPY right here. It's currently at $404. Now I'm going to go out here till September 30th, 2022. And I'm looking at calls right up here at the top. I'm looking at calls. So I'm going to scroll down because right now the stock is currently at 404. So this is I want to sell a covered call above the current strike price for based on what we're at today. My previous example was $4 for $420. If I want that, $420 right here, somebody's willing to pay me about $4. That's 1%. That's 1% currently to wait. Now, a very important aspect here, delta. Delta right here is 0.27. What does that mean? That has to do with for every dollar of change, how much does the option price change? But I want you to remember this, look at it this way. 0.27 is the chance of this, basically the market's chance of this actually happening. So the market's saying it's about a 27.1% chance that on September 30th, 32 days from now, the SPY will be above 420. That's the key there. So you don't want to take that much risk. Maybe you want to go lower. Let's say you want to go to the 10% chance. Sell the 434 covered call and you'll get $1.08. Not as much premium, but way less chance that it happens. 27% versus 10.3%. That's a lot different. So what you need to remember is, what is your risk tolerance? Let's say you have a portfolio when you retire of $4 million. Well, how much is that in SPY? Let's round this down to 400. You have 40,000 shares of SPY. If you want to be conservative and sell $1 each time, you're going to get $40,000 a month. Plus your dividends. Now, keep in mind, based on this, 10% of the time, so about one time every year, you will probably not make as much because the company will end up, because SPY might end up above that. But this is a big jump to happen. I'm okay with that risk. Or like I said before, maybe what you do instead is, if you have 40,000 shares, what you can do is maybe sell 15,000 shares at 430 and collect $1.59, 15,000 shares at 440, collect 56 cents, and then 10,000 shares not covered at all. And you get the full game below it. It's whatever you feel comfortable with. There's no right or wrong. But the great news is when you have a stock that you want to sell, not necessarily SPY, but let's say you do want to sell SPY. Let's say you are sitting there in retirement and you say, you know what? I want to buy a car and that car is going to cost me $50,000. So you might take out part of your $50,000 divided by $400 a share equals 125 shares. So let's make it easy and call it 100 shares. But you want to sell it to generate the money. Well, you know what you can do? Make yourself some big money. Sell one right here at 405. They'll give you $10.60. So if the stock goes, so you're going to get $1,000 just to do that. Let's say the stock goes above, you're still going to lose it at 405, but you're going to do that anyhow. You're going to sell it right then and there. The risk is that the stock goes lower and you could have sold those 100 shares at 405 and you still collected $10. So as long as the stock, as long as SPY stays above 395, which is 405 minus the $10 you got in premium, then you've made more money than you would have just by waiting. Remember, there's no guarantee. And I want you guys to know something. Tim, our CEO, is sitting in the back right now, smiling and shaking his head for how awesome this is. There are no, what was that, Tim?
Why are people even chasing hype?
Well, and that's the thing. Tim's asking, why are we even chasing hype? There's great ways to make a lot of money doing things like this. This isn't free money, guys. There are risks involved. I recently had Foot Locker stock, sold a covered call. They announced earnings. It went through the roof, and I took a big loss in those call options. Why? Because I still wanted to own Foot Locker because I was selling my covered call at a price I didn't want to sell the stock at. And that is a risk. The risk along the way while you're waiting for the company to go up is you might not sell it. The best way to do it is pick a far out date at the price you want to sell it at. That way you give it time to get there. So like, for example, if the company is currently, like I said before, at $20 and you think it's worth 50, go out a year and put 1 year later and pick the $50 strike price, okay? So let's pull an example up for that one. Let's pull up an example of, let's look at Foot Locker. What's Foot Locker looking like? Let's go out a year. So now it's September. Let's go to, well, we can't really go out a year. Let's go out 6 months. Let's go to February. The stock is currently at $37. I could go out to $50 if I think it's worth $50 and I can get 85 cents per share. But I now have to wait 172 days to get that full 85 cents to me in terms of value. And everything above 47.50, oh, sorry, that's $50. Everything above $50, I won't get. So if you like what I'm saying here, join our community In our Bid and Ask Nation, there's going to be focus on options as a way to generate income, with Mo doing options trading several times a week. Thank you very much for your time. Please watch the next video, which is about selling puts to get stocks you want at prices you want, how you can be paid money to wait. Thank you very much. Take care.